Hello everyone and a very warm welcome to today's stock markets update for Wednesday, April the 2nd, 2025. For my premium members, this is take two because I want to keep it simple and I felt the first webcast I sent out to you was too complicated. We were looking at too many things at once, trying to explain what was going on. And I'm just going to focus on the S&P 500, which can then also be applied to most other indexes. All right, the S&P 500 is the most followed index, and it has some setups still possible for not to go to 5100. So let's keep it simple and let's go straight to the charts. Before I do that, the reason that I wanted to do this update is because the futures markets have now undercut the previous low, which we said that one needs to hold. That's Monday's low. If it doesn't, then something else is going on and we will not see minimum more directly. So before we go there, let's remember the ideal Fibonacci based impulse pattern we are following. Assuming our assessment is correct that the rally from the March 2020 low here, so this is the March 2020 low, into the late 2021 high is wave 1, then all of 2022 is wave 2, we should now be in wave 3. So this premise really builds on the notion and assumption that the 2020-21 rally was wave 1, the 2022 correction was wave 2, and we're now in wave 3. If we break below key price levels, then this assumption is wrong. For now, it is holding, and we'll show you in a moment why. In a third of a third wave, we expect it to reach anywhere between the 100% to 123.6% extension of wave 1 measured from wave 2. The fourth low will then go to 61.8 to 76.4%. Since we topped right at 100%, expect the fourth wave go to the 61.8, and then wave 5 of 3 will go to ideally the 138.2% to the 76.4%, makes a higher low, and then the fifth wave. So this is our ideal Fibonacci based impulse pattern / framework. And I'm going to show you that with an article we posted on March 14th publicly, and which of course had been shared with our premium members. So this is the weekly chart back then, as you can see here, March 14. All right. And we were looking for a low, let's see here, at around 5,500, then a bounce back to about 5,900 plus or minus 100, and then a decline to ideally 5,116. Okay, that is the ideal Fibonacci based impulse pattern. And as you can see as well, we topped right here at the 100% extension at around 6120. I believe we got 6140. And this is of course measured from the wave 2 low. Okay, so nothing weird going on right now. So this is then our wave 1 right here. This is our wave 2, and then we're 1, 2, 3, 4, 5 for wave 3, A, B, C lower, and then the wave 3, okay, to the ideally 138.2, assuming wave 4 is going to bottom there at 5116. So what did we get? Back then, and I'll can show you it right now, is where we expected a rally to that 5800 to about 6,000 before we would see a decline. Okay, so red wave 3 peaked at 6128 right there. Okay, so far so good. If the index stalls out at around 5,900 plus or minus 100 and then drops below this week's low, which is of course March 14th, we should expect the 61.8% extension at 5116 to be reached before the red wave 5 kicks in to 7122. That is what we've written. And so far, of course, when you start following this stuff on a daily basis, it gets more confusing compared to when you zoom out and just let it sit and putter for a while. So what did we get? We got, I believe, 58 let's see here, if I do the exact time frame, we got 57.86, say 57.87. So we were off by 13 points on the low end. All right, so this blue was the ideal target zone. Why? The ideal target zone was based on a 50 to 76.4% retrace for the B wave of this A wave. That is the most common, typical retrace level one can assume. However, we can retrace also 23.6 or 38.2%. It's less common, but it is possible. All right, so we have to go by what is most common. You have to see this as a bell curve distribution where most of the retraces are between 50 to 76.4%. Some are a little bit more, some are a little bit less. In this case, we got less. However, this can still target then ideally 51, in this case 15, 51, 16. It all depends, of course, how exactly you align the Fibonacci's. So far, so good. So then this wave count is then most likely wrong because we're now starting to undercut, at least in the futures market, Monday's low. Okay? Monday's low is getting undercut, as you can see here. However, of course, we can always close at the new high. So the night's still long, but based on this, we do want to align things well. It suggests this wave count is not correct. So we're going to put a cross in it for now. What is going on then instead? Well, we can now narrow it down to two examples. This is the most bearish example. A break below Monday's low can trigger a waterfall decline, as I shared in our initial for the wave 3, then a wave 4, then a wave 5. Okay, just to make sure that we have then topped for wave 2 right here in the ideal target zone as we laid out, I think, already on Friday. We did not break above last week's high. That's about 57.87, right? That is not where we broke above. So this is still very possible. 1, 2, 3, 4, 5. And as you can see, the fifth wave Fibonacci target is right here, almost at the ideal 51.16 level. It is somewhere between 51.60 and 51.20, which will be a revisit of the August 2024 low. Early into February was a green wave 5, okay? And this was a ending diagonal green wave 5, okay? The red wave 4 tends to then retrace all of the wave 5 from a 1 degree lower impulse. Nothing out of the ordinary. Again, so far this matches picture perfect with the Fibonacci pattern, 61.8. Okay, if we bottom at 61.8, I expect the market then to rally to the 138.2%. Then drop to 76.4, and from there rally to 176.4. It can always extend for the fifth of the third wave. It can always truncate for the fourth of the fifth wave. And it can always extend for the fifth wave. That we don't know. We can't predict the future. But we're going to use this ideal Fibonacci-based pattern going forward because it has served us pretty well. And sometimes we unfortunately get, even I, confused and kind of stuck in the woods on knowing exactly what's going on. And that's the problem with daily updates. The more you narrow things down, the more confusing things will get. You got to zoom out, all right? Keep a big picture and keep an open mind and know that the market is all about possibilities. So then I want to share with you this one single twist to the plot. Yes, we can still be in this of a B wave. All right. So far, what we got was 3 waves up for wave A, and then we could get 3 waves down for wave B, and then wave C of B to once again that 5800 level. The 50% retrace is at 58.25, meaning the 50% retrace of this decline. This will once again allow us for a 3, 3, 5 pattern, a flat wave B, and then the wave C will kick in, once again back to that ideal Fibonacci based pattern. So this is still possible. The cutoff here is pretty much at 5,400, 53.98, 97-ish, right there. That is the September low. If we go below it at any time, I'll give up hope for this possibility. Okay, so we had 3 up for A, then this was a 5-wave decline for A, ABC for B, and then we should see another 5-wave decline for C of B. And then we'll see another 5-wave rally for this larger C of B. And then we'll see another 5-wave decline into that ideal target zone. So this would still be possible. So we have to keep an open mind. If we break below 5,400 at any moment, then I think we can put a fork in this wave count and we're going to completely focus on the 1, 2, 3, 4, 5. Now bear in mind that of course this can morph into a diagonal. Okay, it doesn't have to be a standard Fibonacci based impulse pattern. It can morph into a diagonal where then wave 3 goes here, wave 4 goes here, and wave 5 only goes to about 5,200. Okay, this is a possibility. Please keep an open mind. We cannot predict the future, but we can only go by these patterns that we know. Okay, this is a known unknown. Okay, with the knowledge that this can morph into a diagonal. So these are the two options we're currently seeing. Unless we open completely in the green tomorrow, then please disregard all I said. The low is in place at Monday's low, and we're going to go to at least 6,000, potentially 6,700. So once we bottom in this 5,100, so you can see there are 2 ways to go there, right? First, we're going to go just to about 5,400. You can see that here, right? The 53.97 level. It's the 100% extension, okay? And then we're going to go back here. If we hold that level and we see a very strong reversal, that'd be fantastic, okay? That can happen over the next few days. There are a few things in the charts. For example, if I would look at the AD line, that really make me wonder, like, wow, there is some internal strength going on here, all right? If we look at the AD line for the S&P 500, then you would say, interesting. Look at that. This is the highest reading we've had since pretty much the decline started in February. So that's quite interesting. Internally, the market is really improving. Okay, so that's really kind of making me wonder, is the market weak enough to completely negate this breakout? All right, of course, we're still making not a new all-time high, but this breakout at current levels is higher than where we were, for example, here in late February, early March. It's higher than where we were in mid to late March. Quite interesting. Now, I don't want to hang my hat onto one single item, but this does make me wonder if the alternative that we are showing is in play, that we will get just a weak drop, meaning that the internal strength of the market will make this rally back to at least the 50% extension. And you can see here a C is 1.618 times the length of A, measured from 5,400, targets exactly this. Then we have a very complex B wave. It would not surprise me. So watch the 5,400 level. If we close below it on strong weakness, it sounds weird, strong weakness, very weak market, then I'm going to look for 5,100 for the impulse pattern. If we hold this 53.97 level to be exact, and we start to see a very strong reversal, I'm going to look here for 58.25, potentially 5,900, potentially almost 6,000 for a extended C wave. So I really want to keep an open mind that yes, a break below can target 5,200, but if we're going to hold 53.97, you see it right here, right? 53.97. If you see that level hold, and then a very strong rally, all right, watch out. We're going to go back again to the 5,800s, potentially to 6,000. And then the market can decide if it wants to set up for another drop or that the whole correction is complete. To be determined wouldn't be my preferred point of view. All right, I hope you really get the idea. I hope you understand that where we were in March 14th still applies. That yes, we did not get the bounce exactly as we wanted it to. but still, we were only off by 17 points, which is 0.3%. That's not too bad. All right. Sorry, this map keeps on rotating, but again, we forecasted 5,800, 6,000, and we got 57.87. So I think we still did a very good job. And then 51.20, 51.15 can still be reached. That would be the ideal scenario. So maybe it's time to just keep things simple, go back to where we came from, showing the path that we outlined is still very operable. You can see it here as well. All right. Very, very operable. And we can still do that C wave lower. And then what we got was a simple zigzag. Now, how would a simple zigzag fit in the bigger picture? Because normally, if we have a zigzag fourth wave, we should have a flat second wave. Okay? Well, we can make this into a flat if we allow for the wave 2 to be moved slightly. Okay? It would not be a problem whatsoever if I make this the wave 2 right there. Then this is wave 1 right there. This one can be moved as well. This is then wave 2. This is then wave 3. All right. This is then wave 4. Sorry, this is then wave 3 there. And this is then wave 2. And this is wave 3. This is wave 4. And we're still missing a wave 1 right there. Then I've solved the problem nice and easy. So then we had a flat wave 2, as you can see here. All right, a flat wave 2. And we have then our wave 3 exactly right. All right, so this works really well. A zigzag wave 4, a flat wave 2. It's the rule of alternation. It's not necessary, it's not a must, but oftentimes when you see a flat wave 2, expect a zigzag for wave 4 or vice versa. Triangles are a little more complicated and less common, so this matches really well. So please keep a bigger picture, and so far things are still moving along a standard Fibonacci-based impulse pattern, nothing out of the ordinary. Once we start breaking, I would say below 4,800 and especially below 34.84, but you'll be out long before it. So below 4,800, it's going to be a very bad sign that we indeed have put in a larger top and I have to reassess my entire wave count. Okay, but for now, please remember we're still in a long-term uptrend. So that is where we're currently at. So once again, we'll see where we're going to open tomorrow. Once again, we keep an open mind and a big picture view. Once again, we're going to zoom back to where we came from. That is the A, the B, and the C. All right. And the C wave most likely underway. You see it here as well. And that we are not in a new impulse higher just yet. It was possible, but then we would have a very truncated C wave. It's possible, I've seen them before, but in this case, a 345 down to the low 5100s would match really, really well. It would definitely wrong foot everybody. We're going to revisit the August lows, or the market has a few more tricks up its sleeve. We're going to hold 5400, and then we rally to about 5800, potentially still 6000, and then we see a bigger decline. This rally going to 5800, 6000 can last for about 2-3 months. It can really last that long. The bounce here, as you can see, just wave A was almost a month. All right, the bounce here was also almost a month. We're going to add 2 more months to it, and we'll already be mid-June, and then the C wave will get us probably into August, September, somewhere around there. Would not surprise me. Okay, and that's really all I have for today. And one more time, the AD line is really strong, very surprising. With that, take care, trade safe, and I hope you really appreciate this Keep It update.